Hello, everyone. I'm Carrie Brandon Elliot, contributing editor at Tax Notes International. And today is the 6th of 7 webinars that we are coordinating with the International Tax and Investment Center on the coronavirus pandemic and emerging markets. The ITIC is a nonprofit research and education organization that since 1993 has provided advice to emerging markets on tax policy and investment strategies. They've coordinated a series of working papers on how the COVID-19 pandemic is affecting emerging markets. Today's paper was published in Tax Notes International on October 12. It's on oil prices and the impact of COVID. The authors are Dr. Carole Nakhle and Theo Acheampong at Crystal Energy in London. Crystal Energy has been around since 2012. And they have provided training, advice, and research to participants in the energy industry, including foreign governments, financial institutions, private companies, and NGOs. Today's paper is about how oil prices and government fiscal strategies are dependent on oil prices, production strategies, and investment trends, and how that's always been the reality, but how COVID-19 is impacting that reality. So with that, I will turn it over to Dr. Carole Nakhle and Theophilus Acheampong.
Thank you, Carrie. Hello, everyone. Thank you for joining us for this. For me, the special webinar, not only because the topic is quite special to me. It's based on an area that I have covered for more than 2 decades now, but also because it's the last webinar for me, at least for this year. And what a year this has been. The paper that Theo and I co-authored looks at a very important aspect that tends to be overlooked in today's discussions about the impact of COVID-19 on government policies, particularly upstream taxation or upstream fiscal regimes for, of course, oil and gas operation. Now, why I say it tends to be overlooked, because usually it takes time for governments to react to these kind of drastic changes that we have seen in the market. And there are the other factors that come into play. But for me in particular, as somebody who follows global oil markets quite closely, I find it missing from the discussion, especially when people talk about just investment decline, and they link only the investment outlook to oil prices, overlooking an important dimension that is government policy and how governments might react in a way which tends to, in some cases, more than compensate for changes in the price irrespective of their direction. But that's why, for me, looking at this particular aspect, the impact of the crisis on prices, investment, and production, in turn on potential fiscal policies that we might see in various oil-producing countries, is very telling in terms of the outlook for investment, outlook for production, but most importantly, outlook for government revenues in general. So we have divided the presentation into several sections, and I will be exchanging slides. Some slides I will cover, other slides Theo will cover, but mainly first to highlight the areas, the kind of provinces we have covered in our paper, and then give you a very, very quick snapshot of the impact of COVID-19 on the global economy, as well as energy markets, particularly oil markets, because that should give us the background needed to analyze the potential fiscal changes. But we're going to look back at what the tradition has been in terms of the key drivers that could create space for governments or give governments an incentive to change their fiscal terms or consider altering or revisiting their fiscal arrangements or contractual arrangements. The list is long, and we're going to see, we highlight most of these factors, but for the purpose of this paper, we focused on 3 closely intertwined factors, namely the oil price effect, investment trend, and production life cycle. Then Theo will go through, give you an overview of some of the case studies we have covered and what kind of changes we could expect to see there. And then we conclude with the main recommendations that we found in this paper. And one of the other reasons that we wanted to look at the past behavior of governments when it comes to prices, investment trend, production trend, or life cycle is simply, if I may quote Mark Twain when he said, history does not repeat itself, but it often rhymes. So yes, we're not going to have just copycat or deja vus of previous reactions, but we can have a flavor of what kind of reactions we could expect by looking at how some host governments have behaved over the last few years. So very quickly, the objective of the paper, and you can see the paper, you can access the paper from Tax Notes website and also from Crystal's Energy website. So the main purpose, overarching objective is to analyze whether host governments in certain provinces, and we focused here on offshore provinces because we felt that they share commonality when it comes to the cost profile. So we wanted to eliminate one factor that could differentiate operations or profitability or returns between one place and the other. So how might host governments react to the current crisis, COVID-19 crisis, which is still with us and might still be with us for a while? And if they do react to the crisis, what kind of measures they are likely to adopt in the more immediate term? And this is a list of the countries that we looked at: Angola, Brazil, Equatorial Guinea, Ghana, Indonesia, Mexico, Nigeria, Norway, UK, and the United States, the Gulf of Mexico. So you can see we looked at both developing economies and developed economies, and we're going to see why we considered that kind of diversified group, because we thought that the economic dependence on oil revenues also affect government choices of reaction to the current crisis. But first, if you allow me a few minutes just to set the scene and to assess the damage that COVID-19 has created. So first of all, we have to remember, and I have to quote the IMF here, that we are dealing with a crisis like no other. So we had the pandemic hitting the global economy all around the world, and with the same degree of severe impact. And as you can see, and then the economy in turn affected the oil demand. So when governments stopped, transport or flying, so people were in a lockdown, national lockdowns everywhere, then airlines were grounded, people were not driving to go to work, they were working from home. And the transport sector is the most important sector in terms of oil demand, so contribution to oil demand. So when you have something so important to oil demand, to the oil sector, suddenly not disappearing, but losing a big chunk of its capacity, then you end up having a collapse in oil demand. Around 20% disappeared overnight, and that led to the collapse in prices. But just to give you an idea of the kind of severity of the crisis we are dealing with, just look at economic growth. So we had a positive growth for the world economy, and of course it varies from one region to the other. So if I look at the Middle East, North African oil exporting countries, their outlook is even worse than what these numbers are, because they started the crisis from a weaker position. They had almost a negative growth at the beginning of 2019. And then they were hit by lower prices, lower volumes because of the OPEC Plus agreement, etc. So this is a general picture of global economic growth. We had a positive growth in 2019, and then look at the dip in 2020. And here I took two sources, the World Bank and the IMF. And it's interesting, if I were giving a different presentation, I'll show you how the forecast kept on being revised throughout the year and actually worsened each time. Because I think we underestimated the scale of the crisis. The good news is that we're expecting a rebound next year. But whether for the global economy or for the energy sector, particularly the oil sector, we have to put the term rebound or recovery into perspective. Of course, when you go quite deep in your crisis, so you hit the bottom low, so any kind of rebound afterwards will look quite positive. So today, when you look back at the previous quarters of this year, you say, okay, we are in a better position. But the big question that remains is that when do we go back to pre-COVID growth levels, whether for global economy or for oil demand? And here, major forecasting agencies tell us it might take a while. So next year, the numbers are going to look better, but it doesn't mean we're going to go back to the pre-COVID levels by next year. We have some structural damages caused by the crisis, and these will take time to be corrected. So they will be with us for a couple of years to come, despite the rollout of vaccination and mass vaccination all around the world. It takes time to assess the damage and recover what has been damaged by such a crisis. Now, on the right-hand side of my slide, I just show here, without going into too much details, the extent of the crisis, the severity of the crisis forced some unusual, if you want, partners or allies to come together to stop prices from declining further. So we saw in April, we had the OPEC plus, which is OPEC plus some of its allies led by Russia. But then we also saw countries such as the US, Canada and Brazil joining forces to kind of put an upward pressure on prices. And here we see whether they have succeeded. So again, here you can see it's amazing that in April, I think it was 19th of April, it was a Monday, I call it the Black Monday for the oil industry, at least in its modern history. You can see that WTI prices went negative, but and of course you can see the kind of collapse in prices between January and April when the COVID-19 crisis became more pronounced. And then of course afterwards we had a recovery. So from April to May we saw a significant recovery in prices, but between June and I would say November, oil prices kind of stabilized within a range of $40 to $45 a barrel for Brent. Yes, recently, again, largely thanks to OPEC plus and the improvement in market sentiment because of the vaccine development, you can see this kind of upward tick in prices. And that's kind of expectations for next year, that we're going to see perhaps prices pushing a little bit higher, but it's not going to be a major deviation from what we saw in the last few months. And you can see that oil prices, even despite the slight recovery recently in the last 2 weeks in December, they are still well below the prices that we saw at the beginning of the year or even last year. Now, such an impact, you see, the first, I would say, obvious, I don't like to call victim, but the players that were badly affected by the crisis would be, in my definition, the oil producing countries, especially those with limited economic diversification. So if you think of countries like Nigeria, or here I would even add to the slide, Iraq, for instance, where almost all of government revenues and you know, the whole economy rely on oil revenues to function, then you suddenly see that majority of your revenues collapsed, more than 60% collapsed overnight, and you don't really have other something else, a safety cushion to shield you from this kind of economic crisis. Then you can imagine the situation in these countries. And just here for simplification, we use the break-even fiscal price, the oil price that would balance the budget for these countries. I mean, look at Nigeria, Equatorial Guinea, Algeria, and even I would include Angola. They all need oil prices of more than $100 a barrel to balance their budget. And the situation is not terribly great for other countries such as Azerbaijan, Saudi Arabia, or Ghana. Maybe Russia is in a slightly better position because they implemented economic reforms in 2000, following the annexation of Crimea and the imposition of sanctions and the collapse in prices in 2014. And this kind of has given them a stronger position with respect to other players. But on balance, all oil producers, you know, whether government or even private sector, and of course, national oil companies, have all been negatively affected. And usually in previous crises, we used to say, if you had investments throughout the supply chain in upstream and downstream, then usually if you have a decrease in prices, you say, okay, I can balance a little bit of that loss with better margins in the downstream sector, such as refining. But in this case, everything collapsed. So both for upstream and refinery activities, or downstream more generally, we saw activities suffering and returns shrinking, and balance sheets, you know, turning, hitting the red zone. I'm going to hand over now to, no, actually not now, sorry, excuse me. First, I would like to, before I hand over to Theo, to give you an overview of what's happening between selection of offshore producers, and that will give us the basis for our analysis. Let me give you a snapshot of the conventional or traditional drivers of fiscal change, and the kind of when you familiarize yourself with all these fiscal drivers or fiscal change drivers, then you will have a better idea of where are you going next as a host country. Now, I have to clarify here, I'm not advocating, nor is Theo advocating, nor is Crystal Energy advocating fiscal instability. On the contrary, we believe that fiscal stability is paramount. It is one of the key principles of an ideal fiscal regime, but we are also realistic, and we know that no fiscal regime is cast in stone. And usually when you have drastic changes to external conditions, then it would be naive not to expect governments not to implement any changes. So among the drivers of fiscal changes, as I said in my opening remarks, the list can be quite long. And there are factors that can trigger relaxation of the fiscal burden, others that can call for an increase in government take. And usually the oil price, I would say, is the most common factor. So rising oil prices encourage governments to increase government take for one of the main reasons that if you ask governments around the world, if you check the objectives that they set from their fiscal regime, you often find the word fair or a synonymous of fair when it comes to the definition of what would they like to achieve from their fiscal regime. So they often say the fiscal regime is designed in a way to give the government a fair share of the returns or the proceeds or wherever you want to call it. But the problem is, how do you define quantitatively what is fair, what is not? So probably something which was generating 60% government take when oil price was, let's say, $50 a barrel, suddenly looks unfair when prices increase to 100 or 110, as we saw between 2011 and 2014, at least summer 2014. So that's one of the reasons why we see this kind of race between the oil price and the fiscal regime. And of course, I'm not talking here about short-term volatility in prices, increase or decrease. That would be a nightmare. Just imagine if you're sitting in the Ministry of Finance or with the tax authority and trying to trace every movement in oil price. No, we're talking here about more sustainable changes and fundamental changes in oil prices. These are the ones that usually trigger a change in the fiscal regime. Mind you, you should not look at these factors in isolation, because they have to be supported by the way the fiscal regime is designed. But for simplification reason, let's just list the main factors. So apart from prices, there is investment trends. Usually you have companies really competing fiercely to acquire blocks in a certain country, or there is a boom in investment activity that also provides an opportunity for governments to perhaps consider tightening their fiscal terms. Positive statements from the industry. And here, I usually work with the private sector. I tell them, be careful what kind of messages you're getting out there. Yes, you want to appeal to your shareholders, but you don't want to raise unrealistically the expectations of host governments or their population. So there's a long list of factors. Let me go through the main ones for our paper: the price, investment, and production, and taking examples from around the world. When it comes to chasing the oil price, perhaps one of my favorite example, even from a long time ago when I did my PhD, the UK was one of the countries that fascinated me the most because of the way they literally chased the oil price with the fiscal regime. Now, I'm not saying whether it's the fiscal regime in the UK is good or bad. I'm just saying that usually the trend, we've witnessed a lot of fiscal changes in the UK North Sea since the beginning of activity in that part of the world in the late 60s, early 70s. So here I'm looked at the last 20 years. And you can see, for example, and you remember the first decade of the century, we had a rapid escalation of various commodities, particularly oil prices. And here the UK fiscal regime was tightened. Now, it was expected because they started from a very low base, in a sense that their fiscal terms, their government take was pretty low compared to other places in similarly competing provinces. So there was a, it would have been simplistic not to expect this kind of reaction. So the government introduced an additional tax called the supplementary corporation tax. And then as prices increased, that rate was doubled up. And then again, there was a resistance after the financial crisis because the recovery was more or less quite quick, especially in prices, courtesy of OPEC cuts. So we saw prices increasing much faster than other commodities just after the financial crisis. And you can see here how the tax rate was increased to 32%. Then, as soon as prices started to decline following the 2014, collapse in prices, where we had, first of all, prices hovering around $110 a barrel between 2011 and 2014. Then, quickly in summer 2014, we saw the collapse to maybe the lows of 40s and 30s in oil prices. And this is where the UK government published a paper calling it Driving Investment, a plan to reform the oil and gas fiscal regime in 2014. And one of the main outcomes was to bring back the corporation tax rate, the supplementary charge, to where it was 20 years ago, almost 20 years ago. And even today, we hear that there could be, the government could revisit once again their fiscal terms. The other factor is the investment trend. And maybe here, Theo can elaborate a little bit more on it when he looks at individual countries. As I mentioned earlier, when you have this kind of perception of rising investment, intensifying competition, you tend to find governments finding it as an opportunity to tighten the fiscal terms because they feel that they can do it without causing too much pain. But of course, when we had in the past significant decline in investment, that caused governments to be concerned and to consider revisiting their fiscal terms. Now, I'm not saying whether they always get to try to compensate for this kind of decline, but at least it makes them consider a tool that can affect directly the investment proposition in their country. They cannot control prices, they cannot control geology, but one of the policy element tool that they can control is the fiscal regime. So that's where they might think that, okay, this is a trend in the market. What can we do to minimize the impact on our industry? Because at the end, low investment, low spending, job losses in the industry, and of course, less revenues for the government. Then my last factor in terms of driver of fiscal change is the production life cycle. Here I took the example of the North Sea again, but I'm going to refer other countries as well, because I like the North Sea because it's a province that has gone through the main cycles, life cycles of any oil producing province. So we saw the rapid increase in production in the 70s and 80s, a bit of slowing down in the 90s in terms of growth rate. And then we had a peak, if you want, in the early 2000s, followed by a decline. So we call it a mature declining province, where new discoveries are simply smaller and smaller than what was discovered in the early days of the industry. And here you can see, for example, it's interesting to see that these neighboring countries, the UK and Norway, although they had different headline tax rates, but they had similar structure, concession regime, built primarily on three main instruments, although the UK tinkered a lot with other instruments throughout the years, but primarily we had royalty, resource rent tax, and corporate income tax. But you can see that in the UK was the first in terms of abolishing royalty, and they did gradually, first on new developments, and then later on, they abolished it for all fields across the North Sea. And then Norway followed later, because you can see production in the Norway peaked later. And that's what you usually see. You find sometimes their government take before really any major discoveries are made tend to be low. when big discoveries are made and the whole perception of their industry changes, then they revisit their terms and they tighten the terms. And then when production enters a declining stage, then again, that could provide space for them to revisit their terms. And here, in terms of the booming side of the industry, not only booming, like today, nothing is booming, unfortunately. But if you think pre-COVID, two countries come to mind. You have Guyana, for instance. If you look at the debate in Guyana, for years, they didn't hit any major discovery. And then, the last few years, ExxonMobil hit a major discovery there. And that unleashed a major new debate in the country on whether the fiscal terms that are there are suitable. We can see organizations such as the IMF calling for adjustments in the fiscal regime to suit the new conditions. Another place that comes to mind is Israel. So Israel, for years, I think from the 1950s up until the first decade of, maybe 2010, they had the same fiscal regime in place until they had massive gas discoveries in 2009, 2010, around that time. Then they applied a moratorium on all activity there, revisited their regulations and their fiscal regime, and then they reintroduced a new fiscal regime with a higher government take, but in opinion is better than what they had because it's more profit related. So as you can see, we cannot isolate one factor separately, but it's like a soup or you're making a cocktail. When you combine these factors together, you can have an idea about the direction of travel for the provinces that we have selected. And here, the main factor that is affecting the outlook of the industry is COVID-19 for the reasons I mentioned earlier, because it led to decline in prices, shrinking revenues. Some companies, they did not pay dividends for the first time in decades. And the companies become more careful and more cautious, government's revenue is shrinking. So you put all these together and you can already have an interesting background in terms of what could happen next. Let me hand over now to Theo to take you quickly through some of the case studies we have reviewed. And of course, we can elaborate more through the discussion with Carrie later on other cases. Theo?
Yeah, thank you very much, Carole. So I will just now discuss some of the case studies. And as already indicated by Carole, we did analyze 10 oil and gas jurisdictions. The notable features that you see, if you can skip to the next slide, please, is that except for Nigeria, that has a reserve to production ratio of about 50 or so years, a lot of the provinces have R2P of less than 20 years. And furthermore, if you look, for example, between Brazil and Ghana, where in both cases oil production is rising, the remaining 8 jurisdictions are mature. So here, production has peaked and is declining in the case of UK and Norway, which you saw a couple of slides ago. There are 4 reasons I think to also note here. One is that despite the maturity of these provinces, they're still directly competing for international capital or investments. They do share very similar commercial and technological challenges in the sense that they have significant potential with deep water resources, and the countries are keen to actually unlock these resources. So again, an example here would be Nigeria and Brazil, whom together have the largest, ultra deep water and deep water reserves, of the 10 jurisdictions that we studied. And lastly, if you look at a number of the countries, oil and gas development and the revenues that come in is quite a priority for them, especially in supporting the public finances and of course the local economy as well. So let's narrow down and just discuss 4 of the countries. We list all the 10 in the paper, but we just would discuss, I think, 4 of them that are very interesting, starting off with Angola on the next slide. So what you actually see on the chart there is that in Angola's case, and of course, I think with Nigeria and Equatorial Guinea as well, you have a big dependence of oil and gas revenues on the whole economy and economic structure, in which case then you begin to see the government attempting to make or do various changes to the regime. What is interesting though is that in the immediate period after the 2008 financial crisis, the government actually lagged behind some of the other countries in terms of making the necessary fiscal and regulatory changes to support the decline in production. So as a result, in 2018, we actually saw the lowest level of production compared to 2007 as like the baseline year. However, the overall government take for a lot of the project was still around 90 or so percent, which is something that you typically would see in jurisdictions that have quite significant resources and reserves. So we had a change in government and a new president came in, President Laurencio, and quickly realizing the extent of the challenge that faces them, started pushing through a number of reforms in the sector in an attempt to halt the decline, but also encourage more investments into the country. And not, surprisingly, you saw the government actually attempting to have the rate on small and marginal fields. And, following on from there, you saw a lot of the industry majors, particularly in this case, ENI, moving in and actually attributing a lot of the discoveries that they made in 2018 and 19 to the new tax measures that the government had enacted in place. But going forward, the government actually wanted to launch a new licensing round. Because of COVID, it actually was postponed. But we think that it is very unlikely that they would be getting some of the big signature bonuses that we saw between 2005 and 2006 with the Kwanzaa Basin bid being replicated. And that's primarily because a lot of the oil companies have other opportunities worldwide across the world, next door, in West Africa, but also in new jurisdictions like Suriname and in Guyana. And in Equatorial Guinea, you also begin to see a slightly interesting picture as well there. So Equatorial Guinea actually took a lot of steps to reform their sector even before the current oil price collapse. And the reason was that between 2010 to about 2019, oil production had declined by about 78 percentage points from a little under 300,000 barrels a day to run around 156 or 2,000 barrels a day. And the projection is that we were expecting further decline of around 6.3% between 2019 to 2024. So the government, again, realizing the difficulty facing them, but also because 65% of their exports come from the oil and gas sector, decided to take a number of pro-investment reforms following the 2014 downturn. And what you then see that manifesting is that the fiscal regime, most of the elements in there are actually fairly negotiable. So this includes royalty, the cost recovery ceilings, the production share, and the production bonus. Almost everything on the fiscal side of the contracts are pretty much biddable or negotiable between the different entities. And then with COVID, the government actually made a further step and decided to grant a number of extensions to the industry. So for example, we saw the grant of a 2-year extension for oil and gas companies to finish their exploration projects. We even saw a waiver of the annual fees that the service companies have to pay to the Treasury. And also we saw the adoption of new petroleum regulations, which the interesting thing here is that they even clarify and define a bit more of what is a marginal field, but also extend the duration of the tenor from the original 5 years now to 10 years. So on the fiscal side, a lot of pro-investment initiatives, a lot of pro-reforms have taken place. However, what we see on the regulatory side is that the government, on the other hand, has actually tightened local content requirements. So it has become fairly more prescriptive since 2014, and that has continued with the COVID-induced crisis, where even some foreign-owned companies were actually did lose their contracts for not meeting the stringent local content requirement. So the story there being that they've been great on the fiscal side, but I also have tightened the regulatory regime in terms of the local content requirement. Let's look at Mexico as well, the third case study I just want to highlight here. The interesting thing is that a lot of the reforms also in Mexico did take place immediately after the 2013-14 crisis, where for the first time the government actually broke up the monopoly of Pemex, the national oil company, into different entities. But when you look at the tax or the fiscal structure itself, again, the regime there has a lot of several progressive features, despite royalties being used as the main element of rent collection. And our analysis also indicated that the Mexican regime actually is quite good at capturing the economic rent for the government. And that's, again, through the layer of the royalty regime actually being, progressive. So it's not a fixed band or a fixed royalty rate. And it also then leads to non-distortion in terms of, the way in which the royalty-based regime is applied. The difficulty, though, is that these changes have not necessarily translated into an increase in production. And subsequently, when a new government actually came in under President Manuel Lopez Obrador in 2017, he did actually state that he was never a fan of the 2013-14 reforms that were enacted, and even threatened to revisit some of the terms in these contracts and further suspend bidding rounds in 2018 right up until 2022. So in Mexico's case, in terms of the post-COVID direction, we tend to see that politics actually is playing much of a bigger role rather than the fiscal regime itself. And lastly, just to touch on Norway, which is a bit of like the extreme case. And usually when we do these sort of analysis, sometimes you hear people making reference to Norway as sort of like the exemplar or best practice in terms of like fiscal stability. That is partly true in the sense that the core ingredients of the Norwegian system or the regime has not changed. So if you go back over time, you actually will see that what the government has consistently done is that kept a very high marginal tax rate of around 78% or so, but they keep thinking at the edges in terms of things like the depreciation rules and front loading some of those depreciation rules to accommodate for the shocks that the industry tends to encounter, for example, because of low oil prices. And with the COVID-induced oil price, the government was a little bit initially unwilling to actually bring down the regime further, because the industry could not kind of justify or demonstrate to the government that it is just a fiscal regime that is, stalling or preventing projects from going ahead. However, the government actually caved in, and what they did here is that they introduced or have introduced a number of fiscal changes to the regime up until 2022. But interestingly, what you see again is that the marginal tax rate is still kept the same at 78%, but they actually have introduced a much slightly bigger uplift on the capex that is spent, and also allowed faster depreciation of capital allowances, including allowing E&P companies to actually, claim some of their back taxes from the government. So in terms of the regime and its structure itself, the marginal rate still the same, hasn't changed, but there's a bit of tinkering at the edges in terms of the substance, which ultimately would then reduce the effective or the average tax rate. So at this point, I would hand over to Carole to kind of summarize for us, what we can glean from in terms of the overall direction of fiscal travel.
Thank you very much, Theo. Actually, listing Norway last allows me to highlight the inherent nature of fiscal instability, because Norway, which is, as you said, Theo, is always used as an example for the most stable fiscal regime in the world. That is true on the main government take, but even then, the regime is not cast in stone. Unfortunately, because we don't have time, I don't want to go through the details of fiscal stabilization provisions. I wrote with a different colleague on that matter, but even that does not stop governments to exercise their sovereign rights, whatever the consequences are. But here, definitely, we have the prominent role of prices, investment, and production trends being the main drivers behind fiscal instability, and we should expect them to exercise their impact in several countries. However, there are other factors that we have to keep in mind. There is a neighborhood effect. So usually governments like to compare what they are doing with what is happening with their neighbor, even though the geology may not be the same or the above ground factors may not be the same, but still there is always this kind of tendency of copycat, let's say, when it comes between two countries bordering each other, rather than countries with, let's say, some geological potential or above ground factors and risk. The third important conclusion that we would like to share with you in terms of affecting direction of travel is that not all fiscal regimes are going to respond in the same way to these factors that we highlighted earlier, because it all depends on the way the regime has been designed to start with. And we found that usually profit-based regimes, and I'm not saying, of course, you have the extreme case, I would say, in Norway and the UK, where you have solely profit-based instruments, then in general, they tend to be better responsive to changes in external conditions, geology, prices, it's their production trend, than, let's say, regressive regimes. So usually they tend to be, profit-based regimes tend to be more stable than revenue-based regimes. And then, of course, here we have to be careful about reaching conclusions about the headline tax rates, and by looking simply at comparing different countries, by looking at the main tax rates, or if I may say, also the government take, can lead you to very simplistic conclusion, because again, the devil is in the detail. You have to see how the fiscal regime is designed. Our fifth observation is that overall we find, and again I say overall because there are exceptions, Theo will highlight in our last slide, but overall we see that the prevailing mood is that the industry is going through a very difficult cycle, and an alleviation of the fiscal regime and or the regulatory burden may be needed. However, here the reaction can vary significantly, and there are many factors. Mexico, for example, we have politics playing a role. But I would also say the following, that typically we find governments acting faster to tightening their fiscal terms than to alleviating them. So it's not really a symmetrical swinging pendulum. So that's one thing to keep in mind. And the other observation is that they tend to use first regulatory changes that don't really cost them money first, and then they would consider the fiscal regime. So their focus is not straight away on the fiscal regime. And then finally, as another observation from the direction, in terms of the direction of the travel, is the kind of investment reforms to be expected. And again, we can be absolutely wrong, because COVID-19 has taught us to expect the unexpected. But I think we should expect an acceleration of pro-investment reforms considered in recent years, particularly in the countries that we have selected. So if they started discussing those reforms before the crisis, most likely they are going to accelerate the implementation of these reforms. Theo, over to you for the final slide.
Okay, thank you, Carole. So I think finally, overall, in terms of our take-home point, as Carole has highlighted, no fiscal regime is actually kind of cast in stone. So you begin to see governments changing or thinking around the edges of the regime as a result of the factors addressed, but particularly when oil prices begin to go down. But we argue that these changes could be made while still maintaining the stability of the overall government take, without necessarily killing the goose that lays the golden egg. But there's also consistency overall in the direction of travel. We think that the pro-investment reforms that are being taken in the jurisdictions that we looked at, given the maturity of the basin, given the dependency of oil and gas for economic survival, that these would likely be maintained in the most medium-term sort of outlook. In terms of the regime itself, what is a competitive regime doesn't necessarily mean that you need to have a lower tax rate, and that between what is profit-based and what is kind of like the regressive regimes, we have seen consistently over the last 40, 50 years that the profit-based regimes are better able to adapt to the swings of the time, and have long proven their superiority over the revenue-based regime, which very difficult to change. And lastly, that yes, governments are very slow often to react to changes in prices, but when prices go up, then yeah, we begin to see them wanting to get more and more of the pie. But also then what that does is it tends to discourage additional investment in the sector.
And with that, we reach the end of the presentation, and we realized that maybe we took a bit more time, and there is a lot more to cover, but for those of you who are curious enough, you can download the paper, and if you have any question, you can reach us directly by email. Thank you.
Thank you. Carrie, I think you're on mute.
Thanks to everyone who joined us. It was a wonderful presentation. And now that we are out of time, I would like to thank everyone for joining us and for the presentation. It looks like profitability regimes are more stable, and the tax rate isn't the end all and be all, is kind of the takeaway I got.
Sorry, Carrie, was that you wanted us to elaborate on that?
I think we're out of time. And so maybe if you wanted to say just a few words.
Theo, why don't you go first?
Yeah, sure. So it's work in progress. We expect the changes to be sustained going into the new year. The other big unknown in all of this is what the energy transition would actually do to a lot of the fiscal measures that we've discussed here. And maybe Carole would want to finish up on that.
Yeah, when it comes to fiscal regime, it's difficult to say what is an ideal one because it doesn't exist, just exists in theory, actually, on paper. But for individual countries, you have to take several factors into consideration. And the problem is that many countries, they tend to either look only at what's happening domestically or what's happening in neighboring countries, but they lose sight of the trends, the global trends, because at the end, investment capital is international. And in periods as we have today, you will have the competition for capital intensifying unless you have you are the Saudi Arabia of this world with massive reserves, low cost of production. Then I think you will have to reconsider what other countries that are competing directly with you are doing, and that is not going to change, I think, overnight.
Okay, thank you, and we'll wrap it up.
Thank you.
Thank you.